let's start from the way beginning. So let's start with the foundation. That is the economy. I want you to think of the economy as the foundation of a house, and a stock as sort of the wood frames that make up the house. So what is the economy? The economy is a big, global, interconnected network of people, businesses, and money. And although some of us may hate to admit it, money is what allows the economy to function. The channels of borrowing and lending and investing sort of keep the world in working order. So again, we are on the foundation of the house, which is the economy. What does the economy need to function? It needs small businesses, because that is how we make food, build computers, pay salaries. But now we are getting closer to sort of the wood frames of the house, right? That's where the stock falls in, or where stocks fall in. So what are your options for starting a business? Option 1, borrow money from a bank. This is taking out a loan. Most people associate this with, student loans, or another example can be taking out a mortgage to buy a house. A loan means that the bank gives you a lump sum payment, depending on what you need, that you eventually have to pay back. Next, option 2, borrow money from a friend. This is how most businesses get started. People borrow money from friends or family because it's easy, it's accessible, and if you have a good idea, some people may be more than willing to lend you money. But this is still a loan in essence. You have to pay back your friend or family member, but maybe you can get away without paying interest. But most likely, you have to pay back your friends with more money than you originally borrowed, so I guess all in all, it's kind of a wash. Option 3, and we're getting closer now. Option 3 is borrow money from a bunch of people who invest in you. For the company, there is no dealing with a bank. You don't have to pay back a loan. You aren't paying interest on a loan. So you may say, okay, well, how is this different from option 2 where you borrow from a friend? This time you're just borrowing from, multiple people. Well, it is different because in exchange for investing your money, the company in return offers you a stake in their company. We call this equity financing. So finally, I think we've gotten to the point, which is sort of the ding, 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 ding. We've sort of defined what a stock is. A stock is just a stake in a company. That's all it is. A company asks you to invest in them, and in return, they offer you a stake or a share of stock in their company. So let's read this sort of blue highlighted box here because I think it's very important. A stake is just a share of stock. When you hear things like, this company just went public, it means they are raising money from many people. In order to raise money, a company agrees to issue a certain number of shares of stock to anyone in the public who is willing to invest in them. This benefits the company because they don't have to pay back any money. They're not taking on any debt. They have minimized the financial danger of the company's original owners, and if the business fails, the losses are spread among many investors. So here's the big question. Why the heck does Wall Street make it so complicated? When you own a stock, you are part owner, along with thousands of other people, of a company. So for example, if a company has 100 shares of stock outstanding and you own 1 share, you are 1 over 100 or 1% owner of that company. You can literally tell your friends that, I own a company. And what people tend to miss is you actually have a claim on all of the cash, equipment, inventory, buildings, chairs, tables, computers, whatever, you name it. You have a claim on all of those things. So you may be asking yourself, why do people say that stocks are really risky? Well, think about it. You're an investor. You lend money to a company. You have no guarantee that you will get that money back. Remember, in a loan, someone has to eventually pay the person back. In equity financing, which is what a stock is, there's no guarantee that the investor, you or me, gets their money back at all. The company could go bust and you could essentially lose all your money. So the only way to get any of your money back when you own a stock is being able to trade it. Trade it with someone else who wants to buy it. And you hope that when you sell your stock, it's at the same price or higher than when you bought it. Start to think about whether you want to invest in stocks. How much money do you actually have to invest in stocks? The first thing you need to do, if you do want to invest in stocks, is you need to open up a brokerage account. And I would say that most brokerage accounts need a minimum of $2,000 to open, but that may vary by company. And there are a variety of choices. You know, there's companies like Fidelity, Capital One, Scottrade, TD Ameritrade, E-Trade, Charles Schwab. They all have great online capabilities that will allow you to get started, you know, with trading stocks and investing. They should also teach you about different products available for investment. We learned about just stocks today, the wooden boards of the house, the analogy that wasn't so great that I used. There are other products that throw a bunch of stocks together so that the investment is a little bit more diversified, and then they package that as one product and sell it. That's an example of a mutual fund or an ETF. After you open up a brokerage account, it's time to start researching companies. That's bullet point 4 on that slide. But again, a lot of my investing was complete trial and error. Don't put all your eggs in one basket. Invest in more than just one stock. And learn about the options you have out there for different things to invest in, different products. And don't be afraid just to try. Remember, it's all trial and error, and every great investor has successes and failures. I've had a variety of successes and a variety of really bad failures.